So, let's talk about a financial option that, honestly, a lot of people have no idea is even on the table: selling your life insurance policy. It's called a life settlement, and it can actually unlock a ton of cash value from a policy you already have. But, and this is a big but, it's a regulated industry. Understanding those rules is absolutely the key to protecting yourself. So, let's dive in. It's a wild thought, isn't it? We're so used to thinking of life insurance as something for our loved ones down the road. But what if it could be an asset for you, right here, right now? That's really the whole idea behind a life settlement: selling your policy for a single lump sum payment. And because it's such a major financial move, there's a whole system of regulations built specifically to look out for you. To really get how these deals work, we first have to know who's who. Who are the players on the field? So let's break down the key roles in the whole life settlement landscape. At its heart, a life settlement is a pretty simple exchange. You're selling your policy for more money than you'd get from the insurance company's surrender value, but obviously less than the final death benefit. The buyer takes over paying the premiums, and you get a chunk of that policy's value in cash today. First up, we've got the owner. Now, that's the official term for the person who holds the policy. And for our chat today, that's you. Every single rule we're going to talk about was written with the owner's protection front and center. And on the other side of that transaction, you have the life settlement provider. This is the licensed company that's actually buying the policy from you. They're the ones who take on the job of paying those premiums from now on, and they're the ones who will eventually collect the death benefit. So where does a provider get all that cash to buy these policies? That's where the financing entity comes in. You can think of them as the financial backers, usually big, accredited investors like banks, who are providing the capital that makes this whole market work. Okay, so now you know the key players. But look, this is not a journey you should be taking by yourself. The most important guide you're going to have through this whole complex process is a licensed broker. So let's take a look at what that really means. This might be the single most important question you can ask. You're trusting someone with a huge financial asset and all your personal information. So how can you be sure they're qualified and, just as important, trustworthy? Well, the answer is in the state's pretty demanding licensing process. Becoming a licensed broker isn't just about filling out some paperwork. It involves required education, passing a state exam, and a full-on fingerprint-based background check. And at the end of the day, every single applicant has to be personally approved by the state's insurance commissioner as being both competent and trustworthy. So, why should you care about all these hoops they have to jump through? It really comes down to one thing. These are all layers of protection for you, the policy owner. It's your guarantee that the person giving you advice has proven they know what they're doing and has passed a serious integrity check. All right, so once you're working with a licensed pro, they have to play by a very strict set of rules. And this is especially true when it comes to how they advertise their services and, maybe most importantly, how they protect your private info. Let's break down what you should expect. The rules around advertising are incredibly strict. All their marketing has to be truthful and can't be misleading in any way. Specifically, the regulations forbid them from using words like free or no cost when they're talking about their services. If you see that kind of language in an ad, that should be an instant red flag. This is a big one. It's probably one of the biggest worries for anyone even thinking about a life settlement. Your medical records, your financial info, it's deeply personal stuff. The law totally gets that, and it puts really tight controls on who gets to see your information and when. The default setting here is that your identity is kept totally confidential. It can only be shared if you give your direct, written permission to get the deal done. The only rare exceptions are for legal stuff, like a government investigation, or maybe to transfer the policy to another licensed provider who, by the way, has to follow the exact same strict privacy rules. All right, knowledge is power, right? So now that you know the rules of the road, let's turn that knowledge into a protective shield. We're going to go over some very specific, prohibited practices that should be immediate giant red flags if you ever see them. Oh, this is a huge one. The law is explicit. You cannot pay a referral fee or any kind of kickback to your trusted advisors. Your doctor, your lawyer, your accountant. The advice they give you needs to be completely clean, not influenced by a potential payday. If you find out a payment like that happened, it's a really serious violation. The regulations are rock solid on this one. The money from a life settlement contract cannot be paid to you in installments. You are entitled to the entire amount in one single lump sum. Any offer that's structured with multiple payments isn't just a bad idea, it's actually against the rules. Remember the superintendent we mentioned earlier? Think of them as the referee for the entire industry, making sure everyone plays fair. So, any attempt to hide, change, or destroy records from this regulator is a massive red flag. It's a pretty clear sign that somebody is trying to cover something up. This one is a nice, simple, clear rule. Once that life settlement contract is signed, sealed, and delivered, it's done. No one can make the insured person get another medical exam. Any request for one after the fact is a big no-no and a definite sign that something's off. And finally, let's talk about one very specific type of shady arrangement that all these regulations are designed to stop. It's known as STOLI, and it is crucial to understand the difference between this and a perfectly legal, legitimate life settlement. STOLI. It stands for Stranger Originated Life Insurance. This is where a policy is basically created from thin air, with the only goal being to sell it to an investor who has no insurable interest, which is just a fancy way of saying they have no family or financial connection to the person being insured. It's literally manufacturing a policy just to sell it. So here's the real difference, and it's pretty simple. A legal life settlement is all about a policy you already own for good reasons. Maybe your life changed, your needs changed, and now you've decided to sell it. A STOLI scheme is totally different. The policy is created from scratch for the pure benefit of some outside investor. And that's exactly what makes it illegal. So after going through all these rules, it kind of leaves us with one final thought. While these regulations are obviously designed to protect you, the policy owner, they also do something else. They create a stable, transparent, and predictable market for investors. And really, that framework is what makes a legitimate life settlement possible in the first place, giving you a powerful financial option. The real key is just knowing the rules so you can navigate it all safely.